gold. We talked about it before.
Yeah, I've been bullish on gold all year.
It had coming off one of its worst day in some 3 years.
Well, that was the employment report. Yeah, but and it's back up to 2,300 plus handle. It's still quite strong. It's up 15-17% year to date. I just think it needs to take a break. I mean, it went up over 20% in about 4 months. So I believe gold is a worldwide economic thing, central bank thing. I think it has to do with worldwide indebtedness, and I think gold should be accumulated on weakness for sure. And even at the level today, I think it's worth dollar cost averaging. I own gold. I've been positive. That was my real asset pick at our DoubleLine Roundtable Prime first week of January. I had no idea it was going to go up so much, but that's the way markets work,
That's the way these price discovery markets apparently work. This chart has, over the last 9 months, weekly spot price data. And you can see typical price sell-offs on phony NFP jobs reports, fiat Fed rate cut decisions, CPI lie data dumps, and COMEX silver futures contract expiry weeks. All the while, physical sucking sound, it's still heading east. Since the start of 2021, the COMEX gold pile has fallen over by half, peak to trough. The London stored gold supposedly held for unsecured gold ETF shareholders has seen a negative 800-ton drawdown. All this while on net, central banks have been buying record volumes of gold bullion in 2022, 2023, and in Q1 2024, thus far reported. Similar story in Western silver exchange reserves, leaving to the tune of negative 100 million ounces since 2021 out of the COMEX piles. Now that's the size of all the silver bullion the Hunt brothers physically stacked in the 1970s and January 1980 peak. Literally gone, pulled from the COMEX over the last 3.5 years. The London stored silver supposedly held for unsecured silver ETF shareholders has seen a negative 8,000 metric ton pull job. That's over negative 257 million ounces gone from London in the last 3.5 years. That is well over the combined amounts of silver bullion the 1970s Hunt brothers and the late 1990s Warren Buffett Berkshire Hathaway stacked combined. Most of it likely went off to India and China. But why? Well, I don't know. How about record global demand for silver, like these representative blue bars exploding higher year after year and the yellow annual silver supply bars not keeping up? Yeah, 4 years of supply-demand deficits. Hence the raiding and scraping of the COMEX and City of London for silver bullion float bars. And of course, raiding gettable unsecured Western gold piles for emerging central banks over the last 3.5 years as well. Later in this week's bullion market update, we will cheerlead specifically for silver and its second half for this year, 2024, examining possibilities using past spot gold-silver ratio breakout analogs from the last 25 years to perhaps extrapolate potential moves to come in spot silver. We'll also talk about seemingly ancient U.S. financial history where the price of silver did a 400x multiple. And yeah, I'm being facetious. There are still elderly people who are alive in their 90s today who lived through that entire 400x silver price move. We'll look at how you might dare determine fair value for silver in such a wild bull market ride. First, let's swing over to Asia to hear from UBS and their acknowledgement that their 2024 gold price forecast was way too low and have now re-rated it for 2,600 an ounce gold spot before the year ends. And meanwhile, UBS's high net worth investment clients have less than 1% allocated to gold and precious metals globally on average. Have a listen.
2,600, that's about what? About 8% higher than where we are right now. Why?
So several factors, I think, at this point in time. So I think the expectation that the Fed cuts policy rates at some point this year, regardless of when that will come, I think is a supportive factor for gold. I think investor sentiment is very strong and they have the space to add allocations. And I think the official sector buying, which we expect will continue, has created a strong base for the market.
Official sector, you mean central banks?
Central banks and other official institutions.
Okay, all right. So here's the thing. You said, look, when the Fed starts cutting, that's going to help, right? It's going to bring yields down. It's obviously going to soften dollar up as well. And we're back to this inverse relationship between gold and dollar, right? Why are we going back to this? Because the rally we've seen in gold has been despite the fact the dollar has been strong and yields have been high.
Yeah. I think the stronger negative correlation is really with real yields, and that's because it is the opportunity cost of holding gold. So the lower it goes, the cheaper it is to hold that position. I think with regards to the dollar, gold has been resilient in this environment where there's a lot of macro uncertainty, there's a lot of geopolitical risk. So we do see gold and the dollar being strong at the same time, and that shouldn't really be a problem, both being seen as sort of safe haven assets.
Okay. Joni, it's interesting, isn't it? When we look at and break down the central bank demand, it's been driven by developed and developing central banks, countries, central banks in those developed and developing markets. On the developed side, even Singapore has been increasing its gold holdings. What's been behind that?
So the official sector gold buying has actually been going on for more than a decade now, and it's really been driven by the need to diversify reserves. I would say the large portion of that has really been driven by emerging market central banks, with the developed market central banks, generally holding high gold allocations from before, basically a legacy from the gold standard. So it's really the emerging market central banks that have been driving the build in gold reserves over the past decade or so.
And is that set to continue, or does it feel like we've seen the high point of global central bank official sector buying?
I think in terms of volumes, it's probably a bit challenging to match the high levels that we've seen over the last couple of years, which is over 1,000 tons. But we expect that the volumes will remain elevated from a historical standpoint. We think there's still room for central banks and other official institutions to add to gold reserves, to diversify their portfolios in an environment where there's a lot of macro uncertainty, geopolitical risks are high. So we do expect this trend to continue for a few more years.
A few more years, huh? That may prove to be an understatement unless we quickly re-rate spot gold a handful of multiples. We are well off where we were the last time gold gave this global full fiat currency regime a full accounting by a manic spot price escalation in January 1980. Supposedly this week, the 50-year petrodollar agreement between the US and Saudi Arabia ended. That 1974 agreement has often been pointed to as one of the major planks used in flooding the world with fiat dollar-denominated IOUs, otherwise known as U.S. Treasuries, bills, and notes, bonds. Google Trends reflects the internet searches. Basically, people have no clue about this. You can see the all-time search spike on the right-hand side of late over the last 2 decades of Google search data for the term petrodollar. Meanwhile, in the 2008 global financial crisis, the Middle East, like many other nations in the emerging world, have been net buyers of official gold bullion. They basically doubled the amount of official gold bullion they have in the Middle East, and it's 3x its value in fiat US dollar terms since. Now, I got a bridge to sell you if you think this is all the gold that Saudi Arabia has. This week, well-known conservative economist Judy Shelton began pounding the Twitter gold bug corner with her new book and take that the U.S. gold reserve pile needs to be unleashed in the form of newly issued U.S. gold bonds. Well, maybe another time we'll get into the details of her pitch, but I want to show you how truly far off the rails we are from the old 1980 level. U.S. official gold reserves haven't changed since 1980, and at the time, the then spot price of gold versus the amount of U.S. debt, bond, bill, note, IOU claims that are out in the world, basically, the price of gold got so high that it covered 40% of the then outstanding debt piles of the U.S. Treasury. Well, in order to do that now, either the spot gold price or the size of our supposed 8,133 metric tons of gold, they combined would need to multiply by a factor of 16 times, and the debt pile would need to stay exactly as it is. Well, keep the 8,133 metric tons of gold and simply reprice gold at 38,000 an ounce, in other words, and voila, we're there. I know it sounds crazy. You got people around the world buying into units of digital Bitcoin at about double that fiat figure. So the psychological road to sums that large for spot gold have already been paid by rationalizations most never thought possible prior. U.S. government spending, much of it deficit spending, is now nearly half of the entire GDP. Let me say that again. U.S. government spending, much of it deficit spending, is now nearly half of our entire GDP. Working for the government is about the only hiring sector in a bull market right now. Do we have an inkling yet of how this debt avalanche is going to end?
Oh dear God.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
The spot silver and gold markets were a mixed bag, with gold leading higher and silver staying relatively flat on the week spot price trading. The spot silver price finished flat at $29.53 an ounce bid, while the spot gold price closed up $30 at $2,332 an ounce bid. The spot gold silver ratio climbed to briefly pierce 80 intra-week, closing at 78. Before we get into further analysis of the spot gold silver ratio in the 21st century, let's have a brief look around the slow but surely failing U.S. bank and U.S. stock market bubble sectors. Heads up, the phony facade's coming down. Those are U.S. regional banks trading again like trash this week. Understandable, the FDIC admits they have over $1/2 trillion in unrealized losses on their books still. Bank loans from the stigmatized discount window are up, and yes, $6 billion is admittedly in bank bucket shop balance sheets kind of tiny, but often emergency bank lending rising higher front runs bank failures galore that follow, a la 2007 into 2008. The major tech and largest cap stocks are having a bubble rally moment. Meanwhile, small caps, about half of them are technically zombie companies, unprofitable, and as well, they're the largest employers of the collective bunch. About 1/4 of the beloved record nominal price-setting S&P 500 is a handful of overpriced companies on virtually any silver metric you choose to use. But I'm sure AI and GPUs are going to save the economy from the garbage fundamentals I just flashed before your eyes. The bloated S&P 500 and the spot gold price have a 1-to-1 parity date ahead in our futures. The current 200-day moving average of the bloated S&P 500 is sitting just over 2,400 and it's rising. Where gold and the S&P 500 are going to meet again, that's tough to say. But gold outperforming and being well north in spot price terms than the nominal S&P 500 index is what promises to follow and endure for some time. Onwards to silver in relation to its potential growing demand from the solar panel sector worldwide. The largest growth sector for industrial silver demand is not going away. In fact, it's set to explode in the projected decade that's going to unfold. China is the leader, of course, and the outrageous price premiums they continue to happily pay above Western spot price quotes is just evidence they need silver for solar and other critical industrial applications. But they're not the only nation in search of silver-laced solar panel build-outs. We got solar panel industry projections calling for a 5-fold in silver-laced solar capacity by the year 2035. Good luck getting enough silver if spot prices don't ramp markedly higher. Turning now to the spot gold-silver ratio breakout from a few weeks ago. Basically, if you look at the entire 21st century spot gold-silver ratio's history, whenever this technical breakdown occurs, spot silver gets on a rapid price performance tear. Christopher Aaron of iGold Advisor posted this wonderful chart illustrating just that. He cites the last 5 technical breakdowns of the spot gold silver ratio in this 21st century here, and how they were all followed by large moves higher in the then silver spot price. He simply took the averages of the last 5 times this occurred and extrapolated them onto the current silver market's potential if history were to rhyme. My sole contention with the timeline here, it seems pretty quick, and it's simply the sheer amounts of spot price interventions we are constantly forced to endure in the long-term silver bull camp. But at some point, the Western world's going to wake up to what's happening and stop giving away silver float dirt cheap to the East and begin betting on its potential outperforming of gold. Whether that happens as quickly as this year or later on, well, place your expectations and long-term bets, I suppose. In the long pull, as Bunker Hunt liked to say, I suggest simply owning outright silver bullion for the long coming haul of this building bullion bull market. For it is within 90-year-olds' time frames and lifetimes that silver did do a 400 bagger in its nominal spot price. The 1933 low of 25 cents an ounce silver coincided with still the all-time high spot gold silver ratio ever hit, reaching over 132 at the time. It was only late COVID March 2020 when the spot GSR ballooned over 128 and the silver spot price dipped to just under 12 an ounce. My point in all this is, how would anyone holding silver over that 1933 to 1980 era have any idea how to judge whether silver was undervalued, fair valued, or overvalued? Well, historical financial data would help. And thanks to Nick Lard of Gold Charts R Us for updating this S&P divided by spot silver ratio chart covering the last 124 years of U.S. financial history, we can garner a clue. There is the 1933 to 1980 move for silver. Basically, you could have ignored silver pretty much until they took it out of our circulating coinage in 1964. You could have simply jumped from the then overvalued U.S. stock market in the 1960s and wrote it down to the 1-2 per share threshold that I'm illustrating here. Basically a level almost reached during the 2011 silver bull market run, a time when 20 ounces of silver or less would afford you the entire S&P 500 share. Here are a couple more charts illustrating that 20-ounce silver for the S&P 500 era last enjoyed during the 1975 to 1985 timeline. If you don't think financial history repeats, then you probably don't know much about financial history. But if you like the idea of owning silver bullion over the bloated US stock market at the moment, you face the real potential of holding and eventually more than 9-folding your S&P 500 stock market buying power as this bloated boomer bubble gives away to mark-to-market reality, and a likely cursed stonk era in the decade unfolding and coming. That's the bet I'm making, and my timeline is long bullion and very patient. That's going to be all for our weekly SD Bullion Market Update, and as always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.